Well, everyone, welcome to tonight's 3 day, or 3 day. No, no, it's not 3 days. Just tonight. Um, our webinar series. We've been teaching this same series for, oh darn it, Scott, it's been almost 20 years now. Can you believe that? And Scott has been with us through almost all that whole time. And we've loved his friendship over the years. I can't tell you how valuable he's been to our students in saving them tens of thousands of dollars, to the tune of hundreds of thousands. I remember a webinar, Scott, you taught. This was probably 5 years ago, and we got a client that went, I didn't need, Scott, you just saved me $150,000 in taxes over the last year just by a little tax tip. I'm not guaranteeing that for anyone. You understand that, but sometimes we take one little tip and then we learn it, we apply it, and then we use it year after year after year. And sometimes it doesn't have to be great big tips. Most of the time, I think Scott's taught us that you kind of win the game with the IRS, sometimes nickel and diming them to death and taking advantage of the tax code. So I'm glad you're on tonight. Let me do a couple quick things. If you're brand new to us, this is a long-standing webinar series. Here are some of the people we've had on this year. We've had a tremendous year with webinars. We teach them generally about every 2 or 3 a month. And so if you're not tuned in, we do record these. We do make them available for a couple weeks after the event. It's usually on YouTube. We encourage you to subscribe to our YouTube channel so that you're aware of what we're doing, but also watch your emails, because we'll post that, we'll send that to you. If you're not getting them, somebody else shared this link. Go ahead and look us up on Protect Wealth Academy on our YouTube channel, on our Facebook page. Come to our Protect Wealth website and make sure you're tuned into what we're doing, because incredible, valuable information. And I really, there's so much. Tonight's webinar, we have nothing to sell. This is informational only. And then pay attention to our Facebook. We Scott, I don't know if you've been paying attention to this, but we've been posting just fun little tax tips. And sometimes we have a little bit too much fun in creating these, but just little ideas that we've learned over the years about how to, and every week or so we post another couple tax tips. So pay attention to that. Like us on Facebook, and you'll have access to all of those. And then we've got a 3-day asset protection summit coming up. The next one is in January. And so I'm very, very glad that you're here tonight. We won't have another chance to teach until, well, that's not entirely true. We do have a webinar coming up. Oh, there it is, next week on oil and mineral rights investing. So join us for that. If that's, especially if you're an accredited investor, there's so many tax advantages and so many things that you can do with oil and gas. So enough of that. Before we get into taxes, there's always going to be a legal and tax disclaimer. Scott can teach tax principles that are general in nature. Does everything we're going to teach tonight apply to you and your situation? And the answer is absolutely not. Always consult with a tax professional before you implement these strategies. So with that, Scott, I don't know that I've ever given you a great introduction. But I'll tell you, Scott has been one of my best friends in the industry. I admire the man, not just because he's a great father, but because of his integrity, but his incredible knowledge on the tax code. He left the IRS. How long has it been? 25, 30 years ago, Scott? It's been a while.
It'll be 30 years next year.
Wow. But you've kept the connections, and you've represented thousands of clients in front of the IRS. I don't know anybody I would trust more with your opinion. You'll find that Scott is very conservative. And what I think most of us as taxpayers want to know is, oh, how far can I push the line? And Scott has been really, really good in helping our students and going. I think you need to take advantage of this one. I think you need to back off on that one, and that's really for me. I want the knowledge. I want the ideas, but I want to know how far I can push it. Not before I get into trouble, but what's legal and what can I take advantage of, and how can I structure my estate so that I can take advantage of the tax code. What I've learned from Scott more than anything else is the critical nature of tax planning. And so with that, Scott, so glad you're here. Thank you for being on. And we're going to turn time over to him. We're going to let him teach. If you have questions, write them down and we'll answer them at the end. But they need to be regarding year-end tax planning. If your situation is unique, specific to you, my aunt's brother-in-law, it lives in Cincinnati, and here's his tax. It wouldn't be appropriate for this. So year-end tax planning that are specific to or general in nature. Scott doesn't know enough about your situation to give you advice over this platform. So welcome, everyone. We're glad you're here. Scott, going to turn the time over to you. Kendall and I will be in the background should you need something.
Great.
Thank you for being here, buddy.
Thank you so much, Don. And just to let you know, I mean, not that I'm counting, but it has been 22 years since the first time I spoke at an event that you were at. It was right in 2001. And but this particular, I mean, we were at that point, Zoom did not exist. So this tonight would not even be possible then. I think it's also the first webinar that I've done looking like I'm getting ready I just came off the ski slope. So this is the first one I've ever done without a suit and tie. So if I seem, a little nervous because I don't have that suit and tie on tonight, cut me a little bit of slack, please. But anyways, I will try to be very respectful of everybody's time. I know that we all have other things to do in life, but I wanted to look at some of the tax strategies that we can utilize now that we're really at the end of the year. So here we are, December of 2023. What is it that we can do, today? And then also maybe looking forward to 2024, since that's right around the corner, as far as what kind of planning are we looking for then? I was telling Don, some of you may have been on, I don't remember if we were recording or not, but for myself, I'm pretty well done with tax planning for 2023. There's nothing else that I need to expense. Most of the income that I'm going to get, I've already accounted for. I may look at my capital gains and do some loss harvesting to offset some of the gains I've had, but otherwise I'm pretty well done. But that doesn't mean that I'm done tax planning right now, because even though I may be done for 23, there's still a lot that we can look forward to starting January 1st. And, I was thinking today, I mean, January 1st sounds like it's just so far away in the future that I can't even imagine, it's like, oh, that's months out down the road. And, here it is really just, a few weeks out. So what I've done for tonight is I put together sort of a baker's dozen of these tax planning considerations for the end of the year. So these are things that I think we ought to be thinking about, assuming that you can fit yourself into some of these tax situations, meaning, you may need to have a business for some of these tax strategies. You may need to have rental property. You may need to have stock market gains or losses, or you may need to have crypto or something other than wages to make some of these strategies play out. So Like Don mentioned at the beginning, none of these, if you look at all the strategies here, if you can pull one or two out that you can use at the end of the year to maybe pull some dollars back, decide to kind of maybe claw back some of that amount that you were going to owe, or bump up the amount that you're going to get back in a refund, if we can do some of these things. So number one is a bunching strategy. It's a way that we look to time income for 2023 or 2024. The same thing with expenses. So you'll notice here, and again, the expenses can be personal on itemized deductions, or they can be business expenses as well. Now, for most of us that have a W-2 job, this income expense timing thing isn't going to really make any difference, right? It's, whatever money we earn in December, it's going to be on our W-2, and we're going to pay tax on that in 2023. But maybe you have a business, let's say my law practice, where I could decide, well, I've done all this work in November and December of 23. Do I want to accelerate the billing? In other words, let's get all this billing out right now, and maybe I can get a lot of this income into 2023 because I've had a really low year and I'm going to make a lot more money next year. Or maybe it's like, man, I've made so much money this year and I don't have a lot of expenses. So I won't want to send those bills out till January of 2024 and defer that income and start looking at maybe there's some business expenses that I can claim here, or some personal expenses. And I'll talk about both here in a few minutes. Maybe I've got capital gains income, or maybe I've got some income over here in a C Corp that I want to take out. And I'm looking at, well, dividends can create double taxation. I know that. But maybe it's better that I do that, and my dividends are going to be taxed potentially at a 0% tax rate, or perhaps a 15% rate, but in any event, less than perhaps the 37% rate if I'm in the top bracket. And so, you look at the wages and the bonuses, and perhaps you can ask your employer to accelerate any bonuses. Let's get them into 2023 so I can pay taxes on them this year because I know I'm going to make more money next year. Or maybe the flip side, it's like, hey, can you throw that into 24? It's like I'm going to get killed in taxes this year. But how can we do timing here? And the other timing issue is on bunching our expenses. And so here I'm talking about itemized versus standard deduction. And when we look at the standard deduction for the next couple of years here, in these two numbers, the first column here is for our single filers. And then if we're married filing joint, we're just doubling that number here. But what this means is that if I'm a married couple and I'm looking at 2023, my itemized deductions have to exceed this 27,700. So let's say I need at least 28,000 of itemized deductions to get there. And maybe I'm going to be really close. And next year, it's even going to be more, right? That next year, if I don't get more than 29,200 as a married couple, I don't itemize at all. And so I'm looking at bunching my deductions. And so in year one, let's say in 2023, I take the standard deduction and I push all of my charitable donations into 2024. So I don't do anything more in 2023. Push all my medical expenses out. I push my next mortgage payment out till January 1st. Let's hope it doesn't produce any negative other results here as far as late payments go or whatever, but let's push that out so that we can get more interest paid next year. And then in December of 2024, we're going to make an early payment for January of 25, so we can get 14 payments in 1 year, in effect, increase the amount of interest. And you can reverse that as well. Maybe 2023, you've already given $30,000 to charity. So we know this number's out because we're already over that. So we want to then accelerate our charity, give as much as we can in December of this year, maybe prepay a mortgage payment, maybe prepay a tax payment, assuming that we haven't already hit a $10,000 cap that we have on these taxes. But again, lots of different options as far as, do we want to take the deduction this year or next year? And for some people, it's like, well, I'm renting my house here or apartment, so I don't have any mortgage interest. And, I live in a state with no income tax, so I don't really have this. And I'm not giving anywhere near 30K to charity. And this medical expense I can't claim because it doesn't go over 7.5% of my income. So these numbers are what I'm going to give, as far as that's what I'm going to get. Then we don't have to worry about the tax part of it. But if we're close, let's look at potentially bunching the deductions. The other thing I like to look at too at the end of the year is any sort of use it or lose it accounts. Now, there's different accounts. This is an FSA, flexible spending account. So don't confuse that with a lot of the HSAs where this use it or lose it provision may not come into play. But when we're looking at some sort of an FSA where we do have, maybe we don't have rollover provisions where we can carry amounts not used into the next year. So make sure before the end of the year that, if there is any dental work you need, or go order eyeglasses or a lot of over-the-counter medical supplies that may qualify for this. So let's not have any funds that we've contributed to a tax advantaged account like an FSA, and then we don't use them all and then we lose it. Look also at any accounts where you can do rollovers. A lot of those accounts, you don't have to take the reimbursement in any given year. So you may want to look at doing these rollovers from one year to the next. So let's say you contribute the maximum. I want to say it's $7,500 a year this year, but don't quote me on that. But let's say you put $7,500 in and you have $5,000 of medical expenses. You may not want to have those reimbursed, but rather have that $7,500 roll into the next year and continue with this tax deferred growth that becomes tax-free growth when ultimately it's used for medical expenses. So something to keep in mind if you don't have a use it or lose it clause in your type of medical plan. Capital gains and losses. This is another one that we want to take a look at because even though there's not going to be any tax rate differences next year versus this year, in other words, all the brackets are going to be the same. They go from 0% to 37%. There's going to be inflation adjustments so that those numbers will be a little bit higher before you reach one of those brackets. But they're going to be typically, are you going to be in a lower tax rate in 2023 or 2024? Now, you may be in a situation where you're going to be in the same rate. And it's like, I'm going to be the same. It's going to be 15% this year and 15% next year. But maybe you're in a situation where this year is a 0% capital gain, as this next slide is going to show you that's not sort of a mistake on my part here. You can see that this is taxable income. So if I happen to be single and I can keep my taxable income under 44K, and I can double that if I'm married and I file joint with my spouse. So as long as I'm under this 89,000 number here, let's say my joint income here with my spouse this year is 70,000. Well, I could take 19,000 of capital gains and pay 0% tax. So if I can do that, let me go back to this last slide here. If I can do that, well, why wouldn't I take that? So let's say I've got a capital gain in Microsoft. I sell the stock, book the capital gain for $10,000 or whatever. I know I'm not going to pay tax on it, and that would reset the basis by $10,000 at no cost to me. Now that's if there's a gain. If there's a loss, we need to be real careful about what's called this wash sale rule, which basically says that if I have a loss and I want to recognize that loss, I'm going to have to wait at least 31 days before I buy the same, or what they say is a substantially similar security. So if I lose money on Microsoft and I want to book the loss against other stocks, or maybe some capital gains I have from real estate or something else, I can't buy Microsoft back for 31 days. So I can buy something else, maybe another tech company or maybe a mutual fund that has Microsoft in it, but I can't buy the same security back. So what I'm doing here is I'm looking at my gains and losses for the year. And if I've got a lot of gains, and I'm going to flip ahead to that slide again, and let's say I'm in one of the higher brackets. So I'm in either I'm going to pay tax at 15 or 20% on those gains. I'm not in this 0% guy. So let's say I'm in the highest bracket here. I'm looking and saying, well, I'm going to pay 20% there. Plus, I've got the Obamacare surtax of 3.8%. So now the IRS is going to nick me for 23.8 plus whatever my state tax is, right? So that could be another 5 or 10%, depending on what that may be. I don't like that. Well, let's harvest some losses. Let's look at some ways that we can, look at any unrealized losses you may have. So for myself, I was a TD Ameritrade guy, which is now Schwab. So I can go to my Schwab account and I can look and I can see, oh, I bought Apple stock. Does that have a loss in it? No. Okay, well, let's go down to the next one and the next one. And I can keep going down until I get to one that's got a loss. And let's say I look at it and it says, I've got a $10,000 loss. I can sell that, harvest the loss, offset 10,000 of gain, and then wait 31 days. So on day 32, now I go and I can repurchase that at whatever the market price is on that day and book the loss. So I've got till the end of the year to do that. Other things we look at here is gifting to a lower bracket. What happens if I've got a big capital gain, but let's say that one of my children is in this little tiny bracket here of 0%. So let's say I've got someone that, a child makes 50,000 a year, is going to get a standard deduction of that, another, whatever that number may be, 12, 13,000, whatever it is. So now this person's taxable income, assuming no other deductions, is, let's just say it's $35,000. And so now I know that this child could take up to a $9,000 capital gain and pay no tax on it. And maybe there's a $10,000 gain, in which case 9,000 wouldn't be taxable at all, and the other 1,000 taxed here at 15%. And so the family would only pay a $1,500 tax, even though if I sold it, I would pay 20% on the whole gain. So we look at gifting as a way that we can get assets out of, let's say, my name and into somebody in a lower tax bracket through gifting strategies. So something to look at, and you've got plenty of time. I mean, we still have, 26 days or so left of the year to be able to get this done if this is something that you're inclined to do. A couple of other things I want you to look at from a deduction standpoint, but also a financial planning standpoint. And, like Don said at the beginning, this isn't financial advice. This isn't tax advice. I don't know who you are. And I certainly am not a financial planner to begin with. But from a tax perspective, this is such a slam dunk that if you have a business, you have an opportunity to contribute to a retirement plan through that business, along with contributing to an IRA if you have some earned income. So if you have W-2 income or income that's taxed for self-employment tax purposes, you can fund this IRA. And you may have a 401k plan at your W-2 job, but you maybe are not maximizing it, or maybe your salary isn't sufficient that you're putting in 22 grand. This is our maximum for this year. It's going to go up a few $1,000s next year. But whatever, for 2023, we still have time to execute the strategy. And maybe your company doesn't match it, or doesn't match certainly the whole amount. So that if you have another business that's on the side, or certainly if it is your primary source of income, you can start looking at really big numbers here, these $66,000 amounts. And it can be either a tax deductible plan, like this 401k or solo 401k plans that I really like, can be, or we can say, nope, so let's skip the tax deduction here, but let's make this a Roth plan. Meaning that, let's say I put in $50,000, or, these are maximums. I can put in less than this, let's say I put in 50 grand and that turns into 50 million, right? Some absurd number. That 50 million, when I take it out, will not be taxed. Not a penny of it will be taxed if I go the Roth option. Of course, for somebody like me that maybe would value the tax deduction more than the Roth component, because I'm older, closer to retirement age, I may like the fact that, that same 50 grand, I can throw that into a 401k or solo 401k plan and get an upfront tax deduction for that. So reducing my income in 2023 by that 50 grand. If I maximize these plans and I'm over age 50, I've got these catch-up provisions that are allowed depending on the type of plan. So yes, I can contribute an extra grand to my IRA. I can contribute an extra 7,500 here to a 401k or a SEP plan. But look how this plays out. Just a really quick, silly, stupid example here that my business takes in 500 grand, spend out 400,000. That includes some salary to me. Probably if I've got an S corp or whatever, I need to take a reasonable salary. So that number is going to be in here. Let's say I paid myself 50 or 100 grand out of that, whatever. But when I get done, all said and done, my S corp kicks out this income here of $100,000. So I get a K1 that says, okay, Scott, on your 1040, you got to report $100,000 of income. And on that, you're going to pay the IRS after we get done with your deductions and whatever. You're going to go from a 30-some% bracket to an effective rate of 24%. And you're going to pay these nice folks, the state of Colorado, another 4.5% or whatever it is this year. So my tax rate, 29%, and I just write out this check for 29 grand and we call it good. Or I make a $25,000 contribution into a 401k plan. So what does that do? Just with this one contribution, it ups my expenses now or decreases my net income by the amount of the contribution and gives me a tax savings of, coincidentally, 29%. So even if I put this into a money market account, right, and I say, no, I don't even want the 5.5% I can get today. I'm good with 0.05%. So I make a penny of income. I've still got a 29% return on that in year one, right? Because I've got this tax savings. And that is critical. Now, again, I'm not suggesting invest it into a non-interest bearing or a barely interest bearing money market account, but just think about if this amount you put in, this 25 grand, returns 10%, right? So now it's returned 2,500. So you haven't been taxed on that. And you've got the tax deduction here that's saving you $7,200 this year. We can really sort of hypercharge the strategy now when we look at one of my strategies of paying your kids. So if you have rental properties, if you have a business, if you have something where your kids have done work for, and again, this is critical that you can't just say, well, I want the tax deduction for 4 grand, so I'll just pay my kids 4 grand. They didn't do anything, but IRS will never know. No, that's not what we're doing here. What we're talking about is if your kids are working for the business, let's get them paid. And if they're working for the business, now let's think about it. They now have earned income. They now qualify for retirement plans. They now qualify for an IRA. Now, can you imagine paying your kid $6,000 for the year and then tell them, oh, by the way, we want to take that whole $6,000 away from you and invest it into an IRA. And now that you're 15, in 50 years, you'll get access to that money, but you'll thank me then. No way, right? That ain't going to work. But you can gift them the $6,000. So if they make $6,000 during the year, you could gift them the $6,000. They turn around and put it into an IRA, one $6,000 contribution, getting roughly this 8% historical average, and they don't do anything else with it. Look at what these two kids, the younger kid getting 2 more years of compounding here. So he or she's getting what about $30,000, $40,000 more, but they've each got $250,000 on one $6,000 contribution, and this has never been taxed ever, and that's in their IRA. Now they make that same investment. So remember, they had over $250,000 here. They do that same exact $6,000 investment, getting the same exact return, but instead every year have to pay their taxes on it. And so I'm just using that 28% number here just to throw out a number here. But look at what taxes does. It drops it from 250,000 or whatever that number is down to less than 100K. I mean, still not a bad number here, but we're talking about all this compounding, and the tax savings here is way more than the value of the investment as far as the compounding goes. So this is critical that I think we look at these sort of possibilities of what can we do as far as getting our kids involved in the business. And yes, this can be grandkids, this can be nieces and nephews, it can be other people that are related to you. Just make sure you document what it is that you're doing, right? What it is that you're paying them for. Because in this case, let's look at the earnings here, and let's say, well, what if they made more? What if instead our 15-year-old made $7,500 during the year, and our older one, the 17-year-old, made $9,000, and now they qualify not only for an IRA, but let's say we have a SEP plan or a 401k plan. So now they max out the SEP and they do the IRA, and again, so their contributions is a little higher. This guy, number one here, didn't make as much money, so their contribution is lower than child number two. So you notice at the end of it, even though this guy has 2 more years of compounding, this one got to make a little bit higher upfront contribution, but each of them has a really nice nest egg, 350K or so. And what would that have been had taxes been involved? Well, a heck of a lot less money. Still a nice investment, but I like this, being able to save this, that we basically just said to the IRS, we're not cutting you in on this deal, that we're going to keep this $250,000 or this $224,000, that we could pay this in tax if we do it in a taxable account, but we don't want to do that. And so we're going to do this in a tax-free Roth account and forget the upfront deductions. Or if for some reason we want those upfront tax deductions, we'll do it in let's say a 401k plan. Tax planning consideration number 6 here. Choice of business entity. This is a good time to look at, did you set up a corporation this year? Because if you did, you set up a C Corp. Okay, that is by default what you set up. Now, if you don't want that, if you want this flow-through taxation, or if you want the tax rates of what we look at the shareholders versus the corporate rate, this corporate guy is 21% flat tax plus plus whatever state you're in. So, but this is 21%. Shareholders could be a lot less than that. They could be 0 or 10 or 15 or whatever. They could be a lot more than that. They could be up to 37%. So do we want this to be taxed, any profits that we have at the C Corp level, okay, which stays with the company, or do we want it to flow through to the shareholders? And if we want it to flow through, did we make the S election? And if not, you better be calling your tax professional tomorrow and saying, did we make the S election for ABC Corp? No, we didn't. Well, it's been more than 75 days. Yes, it has. So we need to do an election here that's late. We need to make a late election. There's a revenue procedure. Your preparers should know about it. And that would allow us then to have S-tax status for 2023. So don't miss this one if it's something that you really wanted to have. Remember on the self-employment tax that, while I love LLCs and I use LLCs taxed as S corporations or disregarded, probably more than any other entities, understand that if we do that with a business, all we're doing is throwing us onto a Schedule C and making us subject to self-employment tax. So understand that if you do the single member LLC disregarded entity for an ongoing active business, you are subjecting yourself to self-employment tax, which you may not want to be doing. So keep those in mind at the end of the year. Also look at assets or equipment or anything that you've bought this year and you're using this little tax quote here, put into service sometime this year. So what that means is that if I go out and I buy, let's say, a new laptop, I've got to buy it in 2023 and I got to fire that laptop up sometime before December 31st at midnight. So even if I buy it on New Year's Eve and I could bring it home and I load it up and I start getting it ready and I put it into service, meaning I start using it for business, I'm good then to deduct that. And with deductions, realize that you have several different options and you're going to need to look at this, that maybe you do have a big profit. So I'm looking at my profit and loss and I'm looking at it, it's like, wow, I've got a $200,000 profit right now. If the year ended today, man, I'm going to pay tax on $200,000 either at the corporate or at the shareholder level. What can I do about that? Well, maybe I want to buy a heavy vehicle. Maybe I want to buy new office equipment. Maybe I want to buy other equipment for my business, for my construction company, I got a medical practice and I'm going to be looking at buying some new office equipment, some new laser equipment that's going to be six figures. And I can buy that in January and wait till 2024, or I can buy that and put it into service this year and use Section 179 to expense the whole thing. Or I can use bonus depreciation to the tune of 80% this year, where it goes down to 60% next year. Meaning that if I bought some medical equipment for $100,000, and let's say for whatever reason I've got a loss maybe, or I don't want to use this for some reason, well, that $100,000 I can depreciate $80,000 this year, and then carry over the next other 20,000 into next year. Whereas if I bought that equipment next year, I could only do 60,000 up front and the other 40,000 would go into 2025. So be aware that asset purchases, equipment purchases at the end of the year, I think are really valuable, really important. But then again, I never liked the tax strategy of, you come to your tax professional and you say, hey man, I got a big profit here, which obviously is a good problem to have rather than, I'm losing money and I'm going to be on the verge of bankruptcy and all this other bad stuff. But I've got this problem, I'm making so much money. And then your tax pro says, well, just go out and buy go out and buy a car. Now go out and buy a vehicle that weighs 6,100 pounds and you can write off 28,000 or 29,000 or whatever it is this year. Plus, after that, we can use bonus depreciation and get you 80% of the next this and start running these numbers. But, and that's all well and good, assuming you're that guy that wants to buy that vehicle. But if you don't want to go out and spend 80 or 100 grand on this vehicle so that you can use some of these Section 179 and bonus depreciation to up your expenses, to reduce your taxable income because you really don't want that vehicle. Not such a good strategy, right? So understand that, if this is something where you're already going to be doing this, you're going to buy a heavy vehicle for your construction business or your rental properties or, whatever it happens to be that you're using this vehicle for, and you're going to do it in the next couple months. Let's look at, are you better off to do that here? Let's accelerate it and do it sometime in the next couple weeks. Or do you want to kick the can down the road and do it in 24? But take into consideration what you look at for 23 year to date versus what your crystal ball says for 2024. Number 8 here looks at potential tax changes for 2024. Here's what I think you want to look at. Personal tax rates. Do you think that your income is going to go way up in 2024 relative to 2023? Or the flip side, do you think 2023 is going to be way higher than it's going to be in 24 when it's going to be way lower? And if you think you're going to have a big difference in your tax rates, that this year I'm going to be taxed at 15%, next year at 37%, then I think you have to look at the bunching strategy that I mentioned up front. You need to start looking at bringing income into 23 and kicking expenses into 24. And likewise, if you're making a lot of money this year and it's going to go way down next year, then let's kick some income into next year when you're in a lower bracket and bring our expenses up. Otherwise, there isn't anyone that I've spoken with that thinks that there's going to be tax increases in a presidential election year in 24. So if you think that Congress is going to raise taxes and Biden's going to sign something like that into effect, no way. Maybe 25, but unless your personal rates are going to change quite a bit, we don't have to worry about tax changes that are going to be negative. Now, they could be something positive, accelerating depreciation or exempting so much money out of this QBI, maybe changing some of the rules in our favor on something. I don't know. I'm not counting on anything in our favor, but I'm not counting on anything to be negative in an election year. So let's move on. Charity. Do we want to take our charitable donations in 2023 or 2024? And for some of us, we're going to take them in both years, that we're going to go over that roughly $30,000 amount for the standard deduction. And so we're taking them either way. Just know that the amount of your donation is limited by two things: what you're giving and who's getting it. So if you're giving cash to a public charity, so I'm giving, let's say, here's $10,000 to a church or a hospital or whatever in cash, I can deduct up to 60% of my adjusted gross income. So if my adjusted gross income is 100,000, I can deduct up to 60,000 of charitable donations, and anything left over gets carried forward and can be used for the next 5 years. And you can see that these amounts, I don't want to spend time on this, but these amounts change, going down to 50% if it's non-cash. So this is if I donate, let's say, clothing to Goodwill. It can go down to 30%. Let's say I donate my Microsoft stock that's tripled in value to a public charity. Well, why would I want to do that? Well, I don't have to pay tax on the appreciation. Whereas if I sell it, I've got a capital gain, and then I can donate the cash. So yeah, I can donate more, but I'm going to pay tax on the capital gain. And then when we get into private foundation issues, the cash or the other property type things take a much lower percentage. But again, what are you giving, cash or non-cash, and who's getting it? A public versus a private sort of a charitable foundation. And that's going to really clue us in on who is going to get what as far as the donations. If you're going to bunch them, though, that's going to make a real big difference. Excuse me. All right. Couple last strategies here. I'll get to the Q&As. I promised you that I wasn't going to go too long here, which I have a timer for 45 minutes just in case you know what or want to know what too long happens to be. But a couple last strategies that I want you to think of. And the gifting strategy, I think, is overlooked all the time because people don't understand the income shifting nature and the opportunity with gifting. Not only does it affect gifting, but it affects this last number here. And I can't emphasize this one enough because our estate tax exclusion says basically if you die in 2023 and your assets are worth less than this 12.9 million number, and that gets bumped up by whatever 600,000-700,000 next year. So if you die and you're worth less than this 13.6 mil next year, there's no estate tax. And so, and if you're married and you have what is called this potability issue where you can in effect double this, so a married couple could have in effect 25, 26, 27 million of assets before they would even think about having an estate tax that would be due. So for most of us, we're looking at this going, hey, well, I mean, I wish I was worth 100 million or something, but I'm not. Even if I'm worth a lot of money. And to me, being worth 5 or 10 million is a huge amount of money. And a lot of us are in that position. A lot of the people that are listening to this either tonight or on the recorded version saying, well, yeah, my assets are worth 10 million or 15 million. And you start throwing life insurance in that and a lot of other assets and maybe some non-liquid assets that you may have. And these numbers maybe aren't that high. But here's the problem. What is this number in 2026? The answer is I don't know. The reason I'm using 2026 is because that's when the laws sunset. And so this number can go back down to 3.5 million. It could go down to 5 million. It could go down to 500,000. They could say that this number doesn't exist anymore and it's zero. And if you're worth $100, you're going to pay tax on that. So all of these numbers, we don't know what the future is. And we don't, fortunately, for most of us, I think, don't know what year we're going to pass away. So we don't know what this number is going to be. I don't know that I'm going to die next year and my estate, as long as it's under 13.6 mil, is good to go, right? That my kids and my wife and nobody's going to have to pay any tax. So we look at gifting. How can I get money out of my estate to the tune of up to 17K a year with nobody knowing about it? And we bump that up to $1,000 next year. And so in theory, I could give my kids, each of them, 17,000 on December 31st and 18,000 on January 1st. I could give them $35,000 over a couple minutes, right? I could do it right before midnight and right after midnight. And my wife could do the same thing. And so we could get $70,000 out of our taxable estate here, no matter what the government does in the future. Even if they bring this down to a really low number, that we get this out every single year. And not only that, but now any income that's earned on this, let's say they sell some stock or they invest it, is going to be at the kid's rate. So whatever my basis is, let's say that I'm giving them $17,000 worth of Microsoft stock, but I paid $7,000 for it. Well, their basis then is the same as mine, that's $7,000. So if they sold it, they would pay tax on the $10,000 gain. But here's the thing, they pay tax at their tax bracket, not mine. And so we want to look at gifting strategies, understanding that when we're dealing with minor kids, we probably want trusts involved because we've got this kiddie tax provision that kicks in for minor kids. So definitely planning comes in here when we have this unearned income, because once the earned income goes over this 2,500, it's taxed at the parent's rate. So be aware that for minor kids, this becomes an issue. But again, we're planning for this year, because we're getting rid of maybe some assets that have appreciated in value. We can make it effective today and then turn around and do it again in January. Tuition and medical expenses is unlimited. So we don't have to worry about that at all if we're going to pay the medical or let's say the college tuition. The other thing is it gets that asset out of the estate. What if I was going to turn that money, that $17,000 that I gave, and I could turn that into, $1 million over a period of time? Now that $1 million is in my estate, and when I die, it's going to be taxed. Whereas if I give that to my kids, now that $1 million, all that appreciation on the 17K gift has now been done in their estate. And so we don't have to worry about estate tax until they pass away, which hopefully is going to be quite a bit in the future. All right, excuse me on that, whatever I just did there to get to the end. A couple last things that I want us to consider here. Roth conversions, if you're thinking about doing it, where you're converting a traditional IRA to your Roth IRA, you're going to do that understanding that this is a taxable event when you do it. So you're increasing your taxes today, kind of a weird tax strategy, right? Normally we're looking at bring the taxes down and pay the taxes later, right? But this one we're looking at bring our tax bill up by converting to a Roth, knowing that we've got all this time for it to grow tax-free. And when we take it out, we're hoping that and expecting that, we're still going to have taxes in the future, and yet this is going to be tax-free. We don't have to worry about these required minimum distributions. So when you see RMDs applying to folks that are now age 73 and over, they don't apply to Roths. So we don't have to do that. And the other thing that I've thrown in there is what happens if in the future Congress eliminates or limits who can do these conversions? And there's been talk about that. And if that actually happens, then you've got yourself covered by making the conversion this year when the law still permits it. All right. And then the final two slides, number 12 and 13. These are the points that I want you to consider here in the sort of the wrap up of final thoughts for the last 3 or 4 weeks of the year and kicking us into January of 2024, which again, I know sounds to me so far away, but obviously the calendar is telling us differently. So we want to clean up any wages that we have to pay to ourselves or our children or any other employees. There's a lot of S corps that I see where maybe the owner hasn't taken any compensation yet this year, and they're going to do the reasonable comp in the last few weeks, which is perfectly fine. Just let's get these wages paid this year to lock in our tax deduction for 2023. Any retirement plans that we want to have, solo 401k, 401k, SEP, simples, whatever it is that you want to do for your work. And then also for IRAs, let's get those contributions made. If we have an S election that we wanted to make, maybe we're late, follow the revenue procedure. Let's get that made so that we don't lose the flow-through status if that's what we want. Couple weeks left to make our Roth conversion. If that's a good move for you, maybe your income's low this year and you don't mind paying the tax. And you can also limit this. You could also say, I'm only going to convert 10 grand so that I know that I'm only going to pay tax on 10,000. So you don't have to do the whole IRA. You can look and say that this is the year I'm going to itemize. So let's get those charitable contributions made this year. This is another year where we can say, yes, we're going to take a distribution from an IRA. Let's say it's a required minimum distribution. And we say, I don't want to pay any tax on that. And so instead of me taking that up to 100,000, so I can go to my IRA and say, instead of me taking 100,000, just donate this over here to my church, or donate this to a hospital or a university or wherever I want that to go. I don't report that $100,000 as income. And that number goes up. I looked at it today before I came on, and this number goes up to 105. So it goes up a little bit next year, but not a big thing. But again, if you're going to donate money to a charity anyways, why take the distribution and pay tax and then get a donation deduction over here? Why not just say, hey, let's not even report this as, here, forget it. And let's go ahead and just give that directly to charity. If you have a holiday work party here, just know that that's 100% tax deductible, different than the 50% normal meals type deduction. And then again, look at the capital gains and losses. If you've got a lot of losses, you may want to take some gains. If you've got a lot of gains, you may want to offset some losses with it. Purchasing equipment for any depreciation, bonus, Section 179. Look at tax credits, electric vehicles. I didn't talk about those, but you can find a lot of info on that if you're looking for, I believe the credit goes up to $7,500. I know a lot of states like Colorado and a lot of other ones have their own credits as well. So you can double dip at the Fed level and the state level. Execute any gifts before the end of the year to make sure that they take effect this year. So don't be making gifts in January and then backdating checks or doing anything weird like that. We're going to take our required minimum distributions if we have to, and we don't want to donate that to charity. or we have to take more than 100K. That's age 73 this year, not that 70 and a half. And then bunch of itemized deductions. Again, whether you're going to itemize or take standard, you can alternate, go year to year. And the only bullet point I didn't mention is the one I want to close with. And this is reimburse yourself with any accountable plan expenses. So let's say you have an S Corp or you've got rental properties or whatever, and you've used your home office or your cell phone or your computer, your laptops, whatever it is that you've done, maybe your automobile. Reimburse yourself for the mileage there. Reimburse yourself for the cell phone bills, and do that before the end of the year. They're called accountable plans because you just account for them, right? That I spent $300 on my cell phone over the last 2 months or whatever. Get those checks written for the distribution or the payment to you now, so that way your corporation gets the tax deduction today, assuming you won it in 23 and not 2024, and you don't have to report that as income. So I'm going to end my presentation 4 minutes over. So I did, I think, pretty good here at trying to keep us on track with a quote here from William Buckley. And I think we may all agree with that there's nothing fair about the income taxes and the income tax policies, but we've got to play by the rules. And we don't always know what the rules are, but get the advice, get the planning, and do it now. Don't wait, because you still have time to make a few decisions here. That maybe something that I had up here on the presentation, or maybe something else popped into your head that you could be doing today that's going to bring your tax bill down come, April 15th or whenever it is in 2024 that you file those returns. So, boy, Don, we've got a whole lot of questions on the Q&A here. Not sure how
yes, we
you
do.
How you want to do this. Wow.
So let me help you, because I've been bunching some of them. I've been reading over them. So how about if we plan to go till the top of the hour and get as many questions in as we can?
Yeah, that's good. I'm good till 8 o'clock my time.
Okay, sounds good. Okay, so any suggestions? Let's start right at the very beginning. Any suggestions for tax strategies for child's college costs?
This is actually a pretty good question now with the timing, because you could, can you pay your child wages? I've seen a lot of places, like my daughters went to school in Fort Collins, Colorado, at Colorado State, and somebody would buy a house, have their kid live there, and then manage the property so that they would get some passive rental income. There'd be active income to the kids, so you'd get tax deductions that are at the parents' rate and not at the kids' rate. You've got gifting strategies that you can set up today. You can get into 529 plans, certainly for education. You can make other gifts under the Uniform Gifts to Minors Act, the UMGA type things. Lots of different strategies. And the best thing that I can advise here is the sooner you start, the better. And I know some of my tax ideas here that I've thrown out may not be very good, because they may count against you if you're seeking financial aid. So you may need to benefit those two. But for somebody like myself, we didn't get any financial aid. And so we had too much money, whatever that may have meant. And so I think you have to look at, the grants, scholarships versus some of the tax deferred and tax-free savings vehicles that you have.
Great advice. And 529 plans don't give you a federal exemption, but they usually give you a state exemption, right?
Exactly.
Roth IRAs or another one, there, if they've got earned income, fund those. Whatever we need to do. Great answer. Thank you. Do I get taxed if I get a settlement from a lawsuit? If so, how much? Can I invest it? If you get a settlement in a lawsuit, is that taxable?
And people hate these questions, right? When the answer is maybe, or it depends, because it depends on the type of what the damages were for. And so sometimes if the damages are reimbursing you for lost wages or something that would have been taxable to you if you would have been working, so they're taxing you for compensation that you missed out on, then those damages are taxable to you. Other types of damages are not, maybe reimbursing you for medical, things like that. You can also look at ways that you have to deduct the attorney fees, because a lot of times the attorneys are taking what a contingent fee's done. I mean, are they like a third today or something?
Yeah,
So you're
30
getting,
to 50% sometimes.
yeah, depending on if they litigate it and appeal it and all that other stuff. So, but there you have to look at, and I think it's real important to have a tax attorney look at the settlement before you sign it, because however a lawsuit is settled there, the terms will outline the damages and what they're for. And so if you're going to get, let's say, $1 million of damages, it'll say 300,000 to reimburse attorney, 400,000 for wages, 200,000 for pain and suffering, or whatever, so that you know what of those $1 million is going to be taxable to you and at what rate.
Really good advice. Okay. I've spent thousands of dollars in 2023 on training, website setup for a new business I'm launching, but I've yet formed the LLC. At what point is the IRS? Okay, anonymous. It's time to set up an LLC. At what point does the IRS recognize these costs as a business expense that you can write off, or is there any relief for those expenses tax-wise prior to the formation? You've got setup expenses, don't you?
Yeah, so those don't really make much difference. I mean, the IRS allows you to start operating expenses when you're ready to take in your first dollar, and not when you do. And so I can go back to 30 years ago when I left the IRS, actually 29 years ago, and started my law practice. In the first month, I don't think I made any money. I'm not really sure if I did or I didn't, but on January 2nd, I was ready, right? I'm there. I'm ready to answer the phone. Let's start this law practice thing. Let's see what happens. So all of my expenses from, let's say, January 2nd on are deductible, whether I make anything or not. But if I look backwards, I can then start looking at my startup expenses. So what did I have to pay to have like a lawyer set up my business, or like this anonymous attendee here is saying, I haven't set up an LLC. Well, when you go to set up the LLC and the attorney charges you $1,000 or $2,000 to do that, that's deductible, and that's a startup expense. Or any marketing, maybe you start advertising 2 months before you open up your pizzeria, to get people aware that you're going to be opening up in February. So those are deductible as startup expenses as well. And you can take those on your very first tax return, whatever year you actually, throw out the sign and, make your first slice of pizza available to the public.
Okay. Another anonymous. I have a few clients with outstanding balances due. It's likely they will pay right before the end of the year, causing my year-end planning to get all messed up. Do you have any suggestions to help me avoid having surplus cash hit the books right now? What do I do to minimize my tax liability? Well, does it depend on how they're paying you? Do you have to cash all the checks? If it's coming in Venmo, you can't really just play with it. But if it's checks, there's a lot of things you can do with
I
that,
think
isn't it?
you hit the nail on the head, right, Don? I mean, here we're all cash basis taxpayers, meaning that we get a deduction when we spend the money, and we recognize the income when we receive it, not when we bill it. That would be accrual basis. So here we've got a cash basis taxpayer. What do? Well, in the last month, or the last week of the year, I mean, don't open your mail, open it in January. I don't know. I mean, so many of the payments we get are going to be by credit card, through our merchant account, or through Zelle, or through PayPal, or, something else, that there's not really a heck of a lot you can do. That, if Don owed me $1,000 and he pays me through Zelle today or through PayPal, and it gets into my law practice account today, I'm going to recognize that as income. I mean, I don't have any choice in that matter. I suppose if you sent me a check today and I don't cash it till the next year, I mean, I guess I could do that, but there you're really just timing it. as far as that goes. And so I've seen people when they're looking at this, you may want to look at having a different fiscal year. You may not want to have your year end on December 31st. Maybe it ends at the end of January or the end of the first quarter or the second quarter. A lot of businesses do a quarterly type of a fiscal year, and get around some of that. But he's right. I mean, that's a good question, right? I mean, you're going to recognize that in one of the years, no matter what.
Right. So, but I can't offset an S corp. I can't offset a partnership, but I could as if I taxed it as a C corp. Is that right?
Yes.
Okay, good. Chad is asking, this may be answered during the webinar. I purchased a truck over 6,000 pounds as a work vehicle, December 26, 2022. He didn't have any income in 22, but he started using it in 23. Truck was $65,000. Your suggestions for Chad?
Yeah. So here's the problem, right? For Chad, and that is he buys a car at the end of the year. He said he paid for it at the end of the last year as a work vehicle. Doesn't say he put it into service last year. So it doesn't look like he put it into service last year, but put it into service January 1 of 23, which means that he can then take the full deduction this year. So he puts the 65,000 down. He would take section 179 on whatever that maximum is, and I want to say it's 28,000, somewhere in that range. He would take 80% of whatever's left as bonus depreciation, and then whatever that amount of money that's left, let's say it's another 5 or 10,000, that would get carried into 2024. And it does not matter. The end of this question was, originally I financed the vehicle. Does that make any difference? The answer is no. So he's not going to get to deduct all of his payments down the road. Maybe the interest on it he will, but the payments he's taken up front and the depreciation and the accelerated bonus and section 179. So good question. He bought it last year, didn't put into the service till January. So now he can take the section 179 and the 80% in 2023, which it sounds like that's what would work best for him anyways.
What if that deduction causes him to have a loss? Does it matter?
Then what happens is that's where people say, well, why would I use section 179 or why would I use bonus when I can just use section 179? And one of the reasons is because section 179 does not permit a loss. So that would mean that I would have to carry it forward and use it where bonus does permit depreciation to incur an overall business loss.
Okay, would gifting strategies work when you're using a trust? And I assume we're talking a revocable living trust or a revocable grantor trust of some kind, not an irrevocable trust.
Yeah, well, they would definitely
strategies work then.
Yeah, they would definitely work for irrevocable, but I mean, most people aren't using those. And, if you're making a gift to, I mean, you're not really gifting anything into a living trust for yourself, but if you certainly could gift it into, let's say, a minor's trust or some other type of a grantor type trust, revocable or otherwise, and the gifting strategy could definitely work. And in fact, that's what you may want to do, that if you've got a minor child and you want to gift 17 grand, put that into a trust for the child. I mean, that would be
that way you have some control over how it's used.
Correct. Yep. Absolutely. Good point. Thank you.
Okay, if I give stocks, how do I do it? Do I need to call the broker, send them to somebody else? Is there a memo of gift? What's the basis? Does the recipient have to report those stocks? How do gifts actually work, Scott?
Okay, good. Yeah, another really good question there. So as far as the gifting goes, if I'm going to do cash or something and it's going to be 17,000, let's have a written report of it. So if you're going to do a check, right, 2023 gift to Sarah or, to whoever it happens to be, put that on there. If it's going to be stock, I'm going to actually do that in my brokerage account. So I'm going to go to Schwab. I'm going to set up a brokerage account for my daughter, and I'm going to tell my broker there, gift, 100 shares of Microsoft from my account to my daughter. And I'm going to add that up, and maybe that comes out to 12 grand. And so then I got another one, and I do it till I get to 17,000. At that point, then my daughter, who gets this 17,000 of Microsoft and whatever else that she gets, steps into my shoes as far as the basis. So if I paid 10 grand for that 17,000, her basis is 10,000. So not the fair market value on the date of the gift, but the basis of what I paid for it whenever I bought it. There's no reporting on that. If I make a gift and let's say it goes to 18,000, and let's say my wife is not involved or I'm not married or whatever, then I, as the person who makes the gift, have to file a gift tax return. So that's where that 17,000 comes in, that if the gift is 17K or less, nobody knows about it, meaning I don't have to file a tax return. If it goes more than that, I do.
Now, even if I file a gift tax return, doesn't mean there's taxes due, but the IRS is going to keep little tally marks of all the gifts you give away in your lifetime.
Yeah, and once you get up to that magic number, that big exclusion number, once you get up to that number, then you start paying tax, and the tax on those gifts can be up to 40%. So we're talking about a very potentially high tax rate on that, but and we don't know what the number is going to be, in the future. So again, it's something we want to look at. And if you're going to give $100,000 gift, well, fine. You're going to file a gift tax return for the 83,000 excess over the 17,000. No taxes due on it. But if you're right around 17 grand, let's keep it at that amount. Let's not go over it, and let's just keep the IRS out of the equation.
Great. Is there a cap relative to my self-employment income that I can contribute to a solo 401k or a Roth?
Yes, there is. That was that 60. I want to say it's 66,000. It was that number, whatever I had on the slides going back.
You know what? Let me share something if you can see this. I don't know. Can you see that, Scott?
I can, yeah. That's the slide that I was kind of looking for right there. Thank you, Don. Because
so, 22, 23, I don't have it prepared for 24. It'll go up, whatever that is.
Yeah, it goes up. I think I heard 3,500, but it's so this person here, because they've got self-employment income, they're both on both sides of that equation. So they could max out here at 66 grand for 2023. When you look at the employer and the employee contribution, if you have enough money to be able to do that. So yeah, you've got.
Yeah, the thing that most people forget is that it still has to be 25% of your salary, right?
On the SEP plans, it does. Yeah, the solo 401ks, we have a little bit better planning on the 401ks on that. I think that's why I like them. I just like the opportunities that they provide. And I like the Roth component too, because this person who sent the question here, I don't know her age. I mean, just to kind of tell you why everybody here that's on this call, we're all so unique, is that I don't know her age. I don't know her amount of income that she makes. I don't know what kind of assets she has. I don't know what kind of investment she has. And so we don't know, is it Roth or is it a regular traditional where we get the tax deduction?
Okay, great. Can you defer income into the 401k and then also do an IRA contribution?
Yes, you can.
As long as we don't go over that, like $66,000 in the previous example.
Right. Plus the IRA, which I think is 6,500 and whatever. So you could do, let's say if you had a, real big plan at your business or whatever, you could max out the 66 and you could throw another 6,500 into an IRA. So you could put 72,500 in there. And then if you were over age 50, you could do another 8,500 between the two plans. You could do 7,500 more in the 401, and you could do an extra grand in the IRA.
And potentially an HSA plan in addition.
Absolutely, you could, yeah. Some sort of medical plan, which you should be looking at that. because again, that's another way that you can get tax-free growth and turn it into tax-deferred growth and turn it into tax-free once you use it for medical expenses. I think it's it's one of those win-win-win. The only one that loses is the IRS, right? Because they're getting less money.
And we're okay with that.
We
Okay. If I'm paying the max for a solo 401k, Roth 401k, defined benefit plan on an S Corp, then how do I take more major deductions, especially if I have more than 300,000 in income?
Well, that's a hard one. I mean, that's a good problem to have because you've got whoever this is has a nice business, right? But what they're saying is they're dumping as much money into these 401 kind of plans that I've been talking about. And those are called defined contribution plans because they tell you how much you can contribute. So this is like you can contribute 66 grand. And then you go ahead and you can invest that however you want. And so at the end of the day, you dump your 66 grand into Enron and you end up with nothing, right? Whereas a defined benefit plan works the other way. And you tell them at the end of it, when I turn 70, I want 100,000 a year. And they go back and they say, this is how much you need to contribute every year through an actuary, through insurance vehicles, what have you, that we can guarantee that you're going to get 100 grand at age 70. And so this person has already maxed out any defined benefit and defined contribution plans, and now is saying, what else can I do? And you may have to start looking now at, well, we don't have anything else on the business side. So now we have to turn to the personal side. Is this something where you may want to start looking at charity, where a charitable remainder trust or some of these other types of charitable vehicles, and maybe making a large contribution into a donor advised fund that's going to allow you some opportunity to make investments in the coming year or two with different charities, whatever it is you want to do. But you may have maxed out all of the so-called, common business strategies that you would have. And now you got to look at your legacy. What is it that you want to do with your money when you're no longer here?
Sometimes building wealth in a C corporation, sometimes looking at shifting income to where now I'm receiving through rents and royalties, and there's so many strategies. Scott, that's I think.
Well, think about it, Don. I mean, what if I'm making a lot of money and I just say, okay, I'm going to donate. I'm going to put $1 million into this charity at whatever I had that slide, 60, 30, 20, whatever it is. So I'm going to get a six-figure tax deduction for that. And then I'm going to deduct the whole $1 million, that I'm putting in over the next 5 years. And I put that into a charity that I control. And now I invest that, and I have millions of dollars that I've never paid tax on. The charity's never paid tax on. The government's never received any tax revenue. And now I can use all of this for my religious purpose that I'm really strong about, or this hospital, or this medical type thing, or schooling, or whatever my 501c3 that I have a real passion about. I've done everything with that. And now they're going to get all this money down the road. And maybe they're getting it every year as I'm making, $100,000 contributions to this through the proceeds I built up in this CRT. So there's lots of things you can do with your money. It just may not be at the business level.
Hey, is it better to defer 401k or pay taxes, Roth?
This is
it so depends.
This is a million dollar question, right?
Oh my gosh.
Do I pay the tax man today, or do I pay him down the road? Because I'm going to pay him either way. And so the Roth guy says, pay him today and keep all the money in the future. And the other guy says, don't pay him today, take that deduction, and we'll worry about the taxes in the future. And so the more time you have between today and when you got to pay the tax man, the more attractive the Roth looks. The higher your tax rate is going to be in retirement, the better the Roth looks. So if you've got 30, 40, 50 years you're going to retire, and you think that taxes are going nowhere but up, you may like that Roth a whole lot better and just pay the taxes today. If you're in the 37% bracket today, it's really hard for me to tell somebody forego the tax deduction because, you put 100K in, it's like that's a $37,000 tax savings to the IRS. And then, this person happens to be in California, right? And so now our 37% is now 50%. I was like, boy, that's some good tax advice, Scott. You just like told me to pay $50,000 in tax because I'm going to go with the Roth plan and I'm going to pay the tax up front and forego the tax deduction. It's like you better have some good financial, transactions down the road to make up for that big tax hit up front.
And it so depends, just
Mm-hmm.
like you said, on your age. I'm 65. I sat down with my financial planner today. I asked him, well, run the numbers. Does a Roth conversion make sense for me at 65? And he laughed at me. Like, no, of course not. You don't have time enough to recoup that. No.
Yeah.
So anyway, think I did this with the IRA for my kids, and lost. I'm not sure what you're asking here. I lost the head of household, then owed the taxes as opposed to the refund I would have gotten. Does that sound right?
Okay.
Not
So this person, I think, is asking, I did something with an IRA and it cost me, I had a household status. So I had a household status basically says I'm not married, but I'm supporting at least one person and paying more than, I think it's half their expenses. And it's a much more favorable rate than taking a single filing status, which
right.
is what you'd have to do if you weren't married. And so, but that doesn't sound right. I don't know why that would cost you that one. The person who wrote this, if you can send me an email, I'll look this up tomorrow for you and see, because if it's right, I'll certainly let you know. But if it's not, I'll let you know how you can go about getting your filing status and getting a refund. So send me an email on that,
Why don't you send it to me,
or
Don
send it
P
to
at
Don.
Protect Wealth,
Yeah,
and
send it to
I'll
Don.
forward it to Scott.
Thank you.
So Don P at protectwealth.com, and we'll see what we can do for you. My
Thank
husband
you.
has a general contractor business and a sole proprietorship in 2023. We are changing for S Corp in 24, but can we contribute December 23 to a SEP IRA with sole proprietorship business and count as a tax deduction?
Okay, I see what they're saying. So
Yeah.
this person has a general contracting business. It's just in it's a sole proprietorship. So no business is set up. Next year there's going to be a business set up. They want to know, can they make the contribution into a SEP plan as a sole proprietor? And the answer is yes, you can. Can they claim a tax deduction for that as a sole proprietor? Yes, they can. Then they go into a next year's plan. Can they do it through the S Corp? Yes, to both. Same answers. You can do it and you get a tax deduction. You can use the same plan as well. Sometimes you may want to set up a different plan. You may have different investment things, but there's no reason why, let's say you're using Schwab, that Schwab can't merge the accounts together because they're both SEP plans.
Okay. I signed up with Anderson. Good. So I don't have my entity set up yet. Sounds like you're brand new to this. Can I still take advantage of these? I assume deductions is and Richard, it depends on when you told Anderson you want your businesses to be effective. If they're not going to be effective until January 1st, then probably not. Scott, thoughts on that?
Yeah, totally agree. It's like, when is the business going to become effective? And again, as soon as you can take $1, that's when all your deductions start.
Right. So if it's effective December 5th, then great. Then from here on out, moving forward, 100%. Otherwise, you're limited to setup expenses, what was ordinary and necessary for the creation of your business, and even that's limited. Is that fairly accurate?
Yes.
Yeah.
Yep.
Go over charitable annuity, a
Uh,
gifted charitable annuity. Does it make sense if you're 85?
well, annuities don't generally tend to make sense at that age, but this is kind of gets very specific. So I think we'd be better off with other questions. I mean, gifted charitable annuities mean that I have an annuity that I'm getting a set amount of money for a certain period of time, usually the rest of my life or 10 years or whatever. And the question is, can I gift that annuity over? And you can on that. The problem is that it's not necessarily coming from an IRA. And so therefore you're going to have to look at taking the amount of the annuity and income and then claiming the deduction for the charitable donation.
Okay. Well, we've got just a couple minutes left, and more questions now than when we started, Scott. Um, these are like little tribbles on Star
Yeah,
Wars that just keep growing. What what about gifting crypto where there's no broker involved? How do you send them crypto directly?
well, you're gonna have some sort of a market or some way to value what the crypto is worth, and so you're going to have some sort of a document that shows what that was, whether it was, Bitcoin or whatever the cryptocurrency is. That if you were going to go ahead and, let's say you were going to convert that to US dollars on the date of the gift, what would it be worth? And you're going to have to document that somehow.
And then look all over the internet or your attorney or your CPA for a memo of gift. But it's just here's a document. You get it signed and notarized, and there you go.
Mhm.
Here's the value of the gift at this present moment, and
Right.
then make sure that you're giving them a present value interest in the gift,
Yeah, I think,
right?
I think if you just, even if you just screenshotted it and it said, that this cryptocurrency was worth $1,000 right now, and I'm giving them 17 coins to make it 17,000. You screenshot that to show the date on it and what it was. Then you show the transaction in your wallet, or you somehow can able to show that that was actually transferred so that you did effectively give up those 17 coins. I think you'd be good to go then.
Great. Does the gift check have to be cashed in 2023?
No, no, it doesn't. But you want to keep that close in time. Don't have them cash it in July or something of 2024, right?
Does gifting less than 17,000 in 2023 need to be reported anywhere? I think you've already answered that.
It
No.
does not. Does not
Okay.
there. Nope.
Okay. Gifting can apply to paying tuition. Please explain more.
Well, you're allowed to pay the tuition of somebody directly without the having to worry about a gift tax return. So let's say that my daughter's tuition was 25,000. I could give her 25,000 in cash, but I would have to file a gift tax return because it's more than 17,000. But if I write a check straight out to the university for 25 grand, I don't have to do a gift tax return because it's for qualified tuition.
Okay. Can you participate in an HSA plan if you have a Cadillac medical plan?
Usually on the big plans, I mean, they require high deductible plans on that. So you have to look at the specific the Cadillac medical plan, and you'd have to see it. What does that cover? What kind of deductibles does it have? What type of plan is it? But the tax benefit of doing it is that you're getting the tax deferral issues in the HSA that you're not getting in the Cadillac plan.
So my guess is no, but talk to your administrator
Yeah.
and find out if it qualifies as a high deductible plan. But that's my understanding is you have to have a high deductible plan to be eligible for an HSA.
Right, that's
Okay,
my understanding as well.
yeah, I gave my son money in 2023 to help pay his student loan. Can I count that as a gift and a deduction? No, it's not a deduction. You still have to somebody has to pay the taxes on it.
Right, right. Yeah, I mean, remember, you don't get a tax deduction when you make a gift, and the person who gets the gift, who receives the gift, does not pay taxes on the money. Okay, so it's tax neutral. No deduction in this case for the parents, no taxable income for the kid, the child.
But what Scott was talking about earlier was giving them a gift that's or an asset that spins off cash and getting that cash out of yours as a tax reduction strategy for you which is very, very different.
Yes.
Okay, when converting to a Roth, you have to wait 5 years so you can pull out the converted amount, not the interest, just the converted amount.
Yes, yes, you do. The question there gets to with Roths, people say, oh, it's never taxed, and that's not true. Yet if you set up a Roth and you take the money out within 5 years, before the plan is seasoned, then the interest and stuff can be taxable. The income can be taxable. The contribution would not, because you've already paid tax on it. So the same thing on a conversion. Yeah, you do have to wait, because otherwise the amount you converted that's already been paid tax on won't be taxed when you take it back out, but the income will.
Yeah, great. I think, Scott, we're over time. Let's take a couple more, and then students. This is going to go on all night if we allow it. Come back and register for a 3-day summit. We're going to try really hard to have enough people to be able to answer your tax questions at that time. Here we go. As an S corporation owner, is it okay to receive pay only once a year to simplify payroll? Do I have to take weekly or monthly, or can I take it annually?
Mm-hmm. Well, the IRS, what they look at is reasonable comp. And so they don't care whether you take it every week or you take it in one chunk at the end of the year. Still got the same payroll taxes. You still got your 941s, your 940s. Everything is the same. You just pay all the taxes in the fourth quarter instead of spreading it out over the year. No problem.
Okay, can an S corporation make charitable donations?
Yes.
Does it follow the 60/40 slide that you showed earlier?
Yes, it does. So the only company that can make a donation and take a direct tax deduction is a C Corp. So you have an S Corp, you can take the S Corp can make the donation, but then it goes on my K1 and I take that on my personal terms return subject to the 60, 50, 30, 20 rules.
Okay,
Okay.
great.
One final question. This one is it. Who gets the last question of the night?
Um, are LLCs able to take accountable deductions or only S corps and C corps?
Ooh, that's a good question. That's a good one to end us on. So any of the deductions that I've talked about tonight pretty much can work for any of the companies. Get into certain fringe benefits, and those really only work for C Corps. Um, but as far as like accountable plans, it can be any type of a business. So C Corp, S Corp, LLC taxed as a C Corp, LLC taxed as an S Corp, LLC disregarded and taxed as a sole proprietorship, and no entity at all, just a sole proprietorship. Not what I recommend, but certainly nothing wrong with it from the sense of being able to use an accountable plan and get reimbursed for these personal expenses that you're spending. You got a cell phone, you're using it for work. Let's get the deduction. Let's allow the business to reduce its income, however the business is set up, and you don't have to pay taxes on the amount you get because it's a reimbursement. So we win on that one. I like that strategy.
When I got into this business 20 something years ago, there seemed to be a wider gap between S corps and C corps, what you could deduct, what you couldn't. And now there's very little difference other than, some, medical reimbursement plans and a few things that are for C corps, education plans, but most of the things that our students are deducting, deduct your cell phone, deduct your internet, deduct home office. That it doesn't matter if it's a sole proprietorship, S corp, C corp, LLC taxed as such. Claim the deductions for heaven's sakes, and I think all the tax tips that you gave today would be eligible. There was nothing exclusive to C corps, S corps. Scott, you gave some really, really good advice. And this is very different. I've watched a lot of your end of the year tax planning. You gave some really good tips that were very creative this year. Thank you for that.
Well,
Students, this has been recorded. And and it will be available probably on YouTube in a day or two. But what will happen is it usually takes about 24 hours. Anybody who registered for the webinar tonight will be sent a recording tomorrow. So listen to this if you'd like to over and over. You can share it with your friends and family and whoever you want to persecute by talking taxes at the end of the year. Scott, I cannot thank you enough for being here. I appreciate your time and yeah, especially your expertise. Yeah, give them a thumbs up or a big heart or something. Yeah, there we go. Students, thank you for sticking with us, especially this night talking taxes. Scott, thank you. And students, join us again next week. We'll be talking not taxes, but tax strategies and investment strategies. And then certainly sign up for a 3-day summit coming up. Remember, the next date is January 22nd, 23rd, 24th. We'll see you then. Scott, thank you very, very much again. Good night.